Hello and thank you for watching Dukascopy TV. Jean-François Owczarczak is back with us in the studio. Using FinGraph technology, we'll be looking at some of your favourite currency pairs. Jean-François, welcome back.
Hi Monica, thanks for having me back.
Pleasure as always. Now we're going to be concentrating on the usual suspects, I believe, today. The markets are still, the emphasis is on the rate-raising reaction after Yellen's speech. But what can we look at this week? What should we keep an eye out for, do you think?
Okay, well, we're first going to turn to interest rates and to the Treasury bonds futures. Basically, can we believe Mrs. Yellen can pull it off? Talking about winding down of quantitative easing, as well as a quite near future rise in interest rates, does mean that she thinks the economy can sustain it. And the whole question is, does the market believe it?
Yes, of course.
So we are on our standard mosaic. We have a euro dollar, a cable, Australian dollar, gold, US dollar Swiss, US dollar yen, S&P futures, and the 30 years Treasury bonds futures. Okay. And we're going to start with the Treasury yield Treasury bonds futures. Basically, for me, it's the most crucial chart today, because it basically tells us, does the market really believe that the economy is strong enough to sustain a rise in interest rates? And so this is an investor's view. So just going to pop the explanation up. It has a weekly chart, a daily chart, and an hourly chart.
Okay.
And basically it allows us to view the trends over these three investment horizons. And as we could see, Treasury bonds, since the first tapering talks last year's had come down. That means interest rates were moving up. And since the month of September, the market is asking itself if this tapering is really going to come true, and so we've seen a consolidation up in the daily chart. So let's have a look at this consolidation, and as you can see, the FinGraph targets are here pointing to corrective targets. That means as long as we stay below them, it is still a downtrend in line with the weekly. If we would move above it, it would mean that Treasury bonds futures would enter an impulsive move up, and that means that rates would be coming down again.
Okay.
And we've seen this correction up linger on since September. It's been much longer than a usual correction, which usually lasts 2 to 3 months, and it's still hitting against the upper end of these corrective targets. If it were to move through them, it would mean that bonds would be resuming the uptrend in quite a strong manner, and which means that interest rates would be moving down again, and that obviously the market doesn't believe Mrs. Yellen can pull it off.
Right.
So we will be watching this very, very closely over the next few months. And if we go back to the investor's view, well, what we see, we're still in a downtrend here, a corrective downtrend. We're in a corrective uptrend here. It hasn't accelerated up, so at the moment the market is still believing that the economy can go into normalization, and the hourly is in a neutral position, although in a bear. If we would want to see the economy strengthen, one of the first clues here would be an acceleration down of the hourly chart. As said, it's still in a neutral position at the moment. Back to the mosaic, and this basically drives almost everything. So what kind of reaction did we have on the speech last week? And we'll maybe look at the euro first. The euro is in a weekly uptrend. It's in a daily uptrend, but getting towards exhaustion. As you can see, we are within the targets here, and there's quite a few stress on our envelopes. And it was correcting down and moved through its corrective targets to create an impulsive target down. Basically, if the economy is in normalization and if interest rates are going to rise, it is quite a healthy situation for the dollar, and at some point we should see the dollar turn up. And so in this respect, we see a weakening of the euro, which over the short term seems to give us clue that it can accelerate. Now, if we look at the mosaic, and it also means that interest rates could rise, and equity markets sustain their very long-term uptrend. Well, over the weekly, we still have some potential up. It is expensive, but there could still be a few months to go. Over the daily, it's exhausted, and at the moment, it's still moving up over the hourly. So as long as we're in this situation, although expensive, it keeps moving up. We shouldn't be too worried of casting too much doubt over Mrs. Yellen's thought that the economy is strong enough. If we look at another asset which is often a proxy for risk averseness, is dollar yen. And if dollar yen moves down again, that means that there is a flight to quality. And so if you look here, the weekly is still an uptrend, so that's okay. The daily is correcting down. It's only a correction down for now. And the hourly is attempting to move back up again. Now, if the hourly were to move back above 103, it would be a sign of a relief. So that would also sustain the idea that a recovery is strong enough. If, on the other hand, over the next few months, dollar yen moves down and breaks 98.93 here, it would accelerate down again, and that would give an opposite indication.
Of course.
Finally, gold last week broke up into an impulsive move on our charts. We did issue warnings saying that we needed to have more clues as if this move was sustainable. Wanted to tie it in with a breakup in the treasury bonds, with a breakdown in dollar yen, and with a breakdown of the markets. We were right to actually post these. Wait a second, see if it's really breaking out. And it's moving down again, and it's gone impulsive over the shorter term. So also here, as long as this is the case, it means that interest rates are moving up, that there's more deleveraging on gold, and that Mrs. Yellen might be right.
So we were rewarded with our patience for the gold. We'll see whether Yellen or not can do it. Only time will tell. But thank you so much for coming in once again, Jean-François. It's been a pleasure.
Thank you very much.
Thank you. Okay, well, that's all from Jean-François and myself for another week, but tune back in next Monday for more of the same. Goodbye for now.